Well, Ryan, I'd like to thank you for taking the time today to join us to have a bit of a discussion about what's been happening over the past three quarters of this year. It's been quite an amazing ride, which I'm anxious to get into further details on, and we're really looking forward to sort of hearing what your kind of the crystal ball gazing is all about, what you're seeing for the future as well, and how things are being positioned in the portfolio. So we've got the sort of material up on the screen. So why don't we dive into that, and I'll pass it over to you.
Yeah, thanks, Scott. Thanks for having me today. Of course, Mike's not able to be here today but says hello to you, of course. Thought we could start talking about not only all the things you mentioned, but provide a bit of a corporate update in terms of what we're doing at CC&L as well. And on the first page of the deck here, you'll see a bit of a corporate update in terms of the last 18 months and what that's been like for us as a firm. As you can see, I'm in the office, and September marked our progressive stage back into the office with over 700 employees around the world. Obviously, Canada being our largest presence. And we've had a seamless transition between technology, certainly, and our ability to continue to serve clients and continue to business as usual, so to speak. But a couple things that I think are most important, and you'll see towards the end of the few bullets here. 2021, we're establishing an office in India. And what we've noticed, especially on the institutional side, our global footprint is growing, and we have more institutional clients coming from outside of Canada, outside of North America. This is going to allow us the ability to be closer to those end clients in parts of Europe, parts of the Middle East, parts of Asia as well. But it's also going to provide a 24-hour trading platform. Right now, if we're trading and investing in companies in the Asian market, as an example, a lot of that trading gets done out of London in the UK office, and we're looking to change that and change the efficiency of what that looks like. And finally, over the last 18 months or so, we've continued to grow quite well, actually, as a firm. CC&L Financial Group now above the $100 billion marker, and the private client group, which we serve private clients across the country, now reaching the $14 billion marker. And something not on the page, but something we'll certainly talk about in the future, our real estate team working on a short-term commercial solution that we think will be ready to go for clients in 2022. And we think if you look at the bond side of the portfolio, which we'll talk about today, how do we mitigate interest rate sensitivity, and what does that look like? So if we go into the nuts and bolts of the quarter and really the year so far over the first 9 months, we'll start off with performance. And you could see those bars we're used to seeing represent the year-to-date returns. And the smaller numbers you see below the bars really representing Q3. On the year, Canadian stocks continue to be most resilient coming out of 2020, return above 17%. U.S. international stocks having great absolute returns, 15% in the U.S. market, 8% in the international market, these both in Canadian dollar terms. We've seen the Canadian dollar appreciate a little bit, so that has impacted these numbers slightly. And we continue to see pressure on bonds. So as rates have continued to increase throughout the year, bonds have provided negative returns. Our portfolios fared a little bit better, which we'll see in a moment, but in Q3 you continue to see that slide as rates have increased. This is something we've looked at in the past as well, and I've brought this back all the way to January in 2020, before really the pandemic and the volatility of the market took hold. And you can see that steep drop in February and March of last year. But if we drive that right through the recovery period to the end of Q3, as at September 30th, since January 2020, equity markets are up about 27%. If we were to look at the bottom, March 23rd of 2020, and where markets have come through over that period of time, markets are up over 50%. If you look at Canadian small companies, over 100%. So you can certainly see how resilient the recovery has been, and what good companies have been able to do over that backdrop as well. If you were to now focus on what was the source of performance, especially on the equity side, and something I wanted to point out a little bit, because we've talked about things like earnings in the past, and I've mentioned in the past, we need to see earnings growth in the future to continue to see strength in the prices of some of these companies. And we've certainly seen that. If you look at index performance on Q3, yes, Canadian equity strongest on the year at 17.5, as I mentioned, but essentially flat in the third quarter. Global stocks leading the way, up 2.5% in Q3, and you'll see local currencies at about 12.5% overall. So that's a combination of U.S. international stocks. But if you look at the breakdown between earnings growth, which is what you see on the right side there in green, and multiple contraction in that yellow color, and as a reminder, multiple contraction really meaning the dollar that investors are willing to pay. And what this is telling us is investors are willing to pay less for every dollar of earnings as companies are increasing their earnings, even though we're continuing to see quite strong earnings growth. So again, a bit of an adjustment into how portfolios are being positioned going forward. And we do think earnings growth will continue to be positive, but as I'll talk about in a little bit, not as strong and not as many positive surprises as we've seen throughout the first 3 quarters of 2021. On this page, you'll get a better sense of performance of our individual solutions, which are represented in the darker green bars. So this is a year-to-date summary, and again, in that far right margin, you'll see Q3, and then you'll see each index that we're benchmarked against, whether that be the TSX, bonds, U.S., international stocks. You'll see the only negative bars at the top of that page there, Scott, on the bond side of the portfolio. So as I mentioned, year to date, Canadian bond universe down about 4%. Our core bond portfolio down about 3%. Adding some value in high yield, adding some value in short term. So we've taken a bit of a barbell approach. We continue to have core bonds represented in a balanced portfolio, but have a barbell on each side representing short-term bonds to lower or decrease interest rate sensitivity, as well as high yield bonds, which we've built up, which again, I'll talk about in portfolio construction, as they do provide better yield and better income over a period of time. You can see on the Canadian side, certainly been a good year for our value team, leading the pack there, 23% year to date, adding 1.5% over the third quarter. And you can see Canadian equities continue to be strong. As we move down, you'll see global stocks, and you'll see, for example, the MSCI World, excluding Canada, up about 12.5 or 12.6%. And our global equity portfolio slightly lagging at about 10.8 or 11%, certainly adding some value on the quarter, but a little lagging on the year, and notably given our more defensive posture. Cyclicals have outperformed in Q3. We've been balancing the portfolio, taking a more defensive stance going into the end of the year, having less exposure to cyclical type names, and therefore becoming a little more defensive, and therefore underperforming slightly. But we think it'll certainly pay off as we expect to have lower volatility and capture less of that volatility going forward. You'll see alternatives at the bottom of that page, really reporting to the end of June and to the end of July, on track to meet all expectations going into the year. And you'll see multi-strategy there at the top at 7.7% year to date, 3% on the quarter. And again, we're sourcing any positions in multi-strategy directly from core bonds. So if you compare that 7.7 to that -3, adding value of about 10% to the multi-strategy portfolio. So all of the companies we like certainly outperforming the companies we don't like. And again, in our view, where portfolios construction is concerned, we certainly believe it provides a better risk-adjusted return than loaning money to the Bank of Canada, loaning money to provinces, especially at inflation above the 4% marker. As we were to, we'll look at multi-strategy again, and as I mentioned, the performance not only year to date, but on the quarter of 3%, and again, sourcing that and comparing that directly to core bonds. And there's that 10% added value on the year and about 3.5% added value on the quarter. So didn't want to belabor the point too much, but it's certainly worked out well from a portfolio construction point, and we think it'll continue to work out well. As a reminder, the multi-strategy portfolio is a portfolio that's meant to have no relationship to the overall market, a portfolio of our best ideas, coupled with companies that we believe won't perform as well going forward, and again, having a great 2020, but also having a great 2021.
Well, so a question on that, because the multi-strategy, I mean, it's been that great alternative for some of the fixed income, exposure. Well, actually, a lot of the fixed income exposure, because I mean, the writing's been on the wall for quarter after quarter after quarter, with interest rates being so low and rising. We've got a real headwind against the typical fixed income approach, and so being able to
Mhm.
to migrate and transition some of the portfolio into this asset class really gives the ability to keep the mandate of the portfolio in check. So you're not taking on added risk in order to do so. And you're also gaining some return because of the way that the portfolio is managed. But I guess my question then becomes, I mean, without a multi-strategy pool to turn to for to help mitigate some of the headwinds that are on the typical fixed income, what are people doing?
Yeah, it's a great question, Scott. People who don't have the ability or choose not to invest in solutions like multi-strategy or other alternatives are in a bit of a pickle, so to speak, right? You have to be able to accept the volatility on the bond side of the portfolio, unless you're willing to go up the risk curve and add more stocks. Now, we don't think you have to, but if you didn't own or didn't have the ability to own a strategy like this, you have to do one of those two things. You have to either go up the curve in terms of risk and the volatility you're willing to accept by increasing the equities within the portfolio, or you simply have to accept over the next, call it 5 to 10 years, the ability for bonds to detract and provide negative rates of return. That's what the math tells us. So if you didn't have one of those two things, then the multi-strategy would be the best solution.
Yeah, well, no, but I guess that's my point, is that without these alternative offerings to be able to turn to and use, and I mean, you've got a much bigger toolbox than most. So without these tools in the toolbox, I guess I just wonder what the average investor who's just on the retail side, so to speak, that just has access, because I think access is the real issue here. They just have access to stocks and bonds. And when you only have those two tools to work with, and you're in an environment where we've got low interest rates and rising interest rates, and you've got a market that has, had some huge steam put into it, I guess to me, it just screams that there's a tremendous amount of risk. I guess risk being put into, or that's in a portfolio that doesn't have an alternative to turn to help mitigate some of that risk. So I guess it concerns me a little bit, because when we do experience some of that volatility going forward, my concern would be that people would let emotions kind of dictate their investment decision making process, and would make some pretty bad decisions at a pretty rough time.
Yeah, absolutely. And to your point, Scott, around our toolbox, this is why we're continuing to look at the toolbox and the risks and exposures that we have in the capital market, and then how these things work together to ensure we don't necessarily have to increase volatility all the time to seek out rates of return. Again, which is why our teams are doing some work with short-term commercial mortgages as an example, another tool in the toolbox. So it's a really good point. And yeah, you'd have to be willing to either increase a bit of risk, or be a more emotionally tolerant on with more volatility, because if you need to produce a rate of return, bonds certainly aren't going to get you there. And bonds also have an inherent risk in them. Of course, it feels a little more comfortable working through a bond market period of volatility than an equity market period of volatility, but that's the expectation going forward.
Interesting.
So we were to focus on the crystal ball, so to speak, and what we're seeing in the market, how we're positioning portfolios, there continues to be positive attributes to the economic backdrop, and of course, there's always risks that are on our radar as well. If we were to look at economic policy, on the monetary side, policy has been quite accommodative. Central banks, the Bank of Canada, the Federal Reserve, decreasing rates to zero, providing a lot of liquidity into the market through bond purchasing programs. And now they're beginning to withdraw and taper some of those bond purchasing programs. Also talking about increasing rates in the future, which we'll talk about a little bit as well. On the fiscal side, though, there continues to be a lot of stimulus that's gone into the market. We've talked about that in the past. We're also starting to see infrastructure spending and what that looks like, not only in Canada, but the North American and global market as well. Where the economy is concerned, well, growth has been robust. It has been, highly positive, but we believe that it'll continue to narrow, meaning it'll continue to slow month over month going forward. Our view is it'll continue to be positive, and therefore we don't expect negative growth. But as an example, in 2021, if we expect the U.S. economy to grow by 4.5%, we expect that to be about half in 2022 and years ahead at about 2.5%. So again, a more normalized type of growth for US GDP, but certainly not as robust as we've seen so far. But the hard data, continues to be positive. We continue to see job growth. We do think there's a little bit of slack in the job market. We do think there's some gains to be made there, but we're continuing to see good, for example, PMIs that continue to be positive. So although narrowing a little bit, all these numbers continue to be on the right side of the ledger. On the health side, of course, we continue to live through a global pandemic. Cases globally continue to be higher, and it may be something that we continue to see, but we've also seen vaccination rates also increase over a period of time. And the government response in terms of lifting restrictions has also been a positive attribute for the economy around the world as well. Now, if we were to look at, this is something we've looked at in the past, and we talk about, I talked a little bit about economic growth, monetary policy. We'll bring inflation to the mix as well. If we were to chart these things, economic growth, it's strong, but not as strong as we've labeled it in the past. I'll look to the other side, and monetary policy continues to be quite easy, quite accommodative, but moving in the tighter direction. Federal Reserve, Bank of Canada has already tapered their bond purchasing program, and we expect, because inflation in the middle there, tracking above trend, tracking significantly higher this year than it has in the past, it also produces some ammunition for them to increase rates a little bit sooner, potentially a little bit quicker. So we think in the back half of 2022, we'll start to see those rate increases. That'll increase and put further pressure on short bonds and bonds in general as well. So normally a positive for the economy, a positive for stocks, but again, placing some pressure on the bond side of the portfolio.
Now, when that happens, I mean, because obviously, the Feds can't continue to be buying the bonds all the time. They've got to get them into the open market. But when they start to, I mean, they've begun to taper some of their bond purchases, and they've begun to sort of, I guess, slow the drip down, so to speak, that's being injected into the economy. But is that not going to, I mean, with these trial balloons that are being, mentioned in forward-looking statements from some of the regulators, is would these not be some of the triggering events that are going to trigger some of the sort of the volatility?
Well, absolutely. So, when we look at what that potential volatility looks like, it's certainly going to be higher going forward than it has been in the past. We haven't really seen in 2021 a lot of, if you were to look at the TSX or the S&P or the Dow, a lot of days that are really below that 1% marker, especially on the negative side. So that's also concerning. And but on the other side, Scott, we do think that the stock market per se has the ability to tolerate higher interest rates, and in fact, the economy can sustain higher rates, it becomes a question around how are you exposed, what type of sectors, what type of companies are you exposed to, what do their balance sheets look like? As rates go up, companies with high amounts of debt on their balance sheet will be penalized. And as an example, looking at our portfolio, energy over time has been a sector where these companies have been forced to take on more debt. And we're also going through a period of time where there's a high degree of focus on environmental and social and sustainability concerns around these companies, and they will require more capital going forward. So again, that's just an example of pressure on companies that have high amounts of debt, which their debt burden will increase over a period of time, that may not produce as robust returns going forward, and therefore increase volatility. So the market in general, we think, can tolerate some higher rates from here, but it's going to be very specific in terms of the companies you want to be exposed to.
Yeah, and I think as well on top of that, you add inflation into the mix, and you've got to make sure companies that you're investing in can actually raise prices during inflationary times in order
That's right.
to
Yeah.
help accommodate against that. So yeah, I would think it's becoming more and more of a stock pickers market. You've got to be pretty sure. You've got to be able to do the deep dive into each particular security to make sure that you're being able to check all those boxes, that it is, a company that, is not going to be laden with debt. If interest rates rise, it's going to be a negative effect on that company. That a company is a company that has the ability to raise their own prices for their product or service or whatever they're offering during an inflationary time in order to keep pace with inflation. So, the headwinds that are in front of us are huge, and if we don't have the ability to find those gems in the pool of marbles, it's going to be difficult going forward for sure.
Yeah, Scott, you brought up such a good point in terms of a company's pricing power and their ability to defer and increase prices on the end consumer. And as we've essentially had shifts with our portfolio construction, become a little more defensive. We've also focused on companies that have the ability to pass on that inflation, that price increase onto their end consumer. I'll give you one quick example before you move on. There's a company in Canada called Element Fleet. Element Fleet, a large holding within the portfolio, done quite well, but they essentially manage fleets of vehicles for a lot of the companies that are household names. Companies like Amazon is an example where they manage the fleet of delivery vehicles in Canada. As we've seen the price of oil, the price of gas increase, costs on insurance, the cost of vehicles themselves, as auto manufacturers seeing pressure on chips. We've never seen a period of time where you have a company like GM fighting with a company like Apple because they both need chips, because chips are going into everything that we're buying on a daily basis. So these are things that we haven't really experienced in the past. But going back to Element, they have the ability to pass on those additional costs to their customers, like Amazon. And Amazon is obviously has the ability to increase those costs themselves and bear the brunt of those costs. So those are the types of companies we like, especially in an inflationary environment. But yeah, there's a lot of things in the market that we're observing today that we necessarily haven't observed in the past. And listen, we'll talk about the supply chain. I'll talk about it in a few charts going forward. Also putting a lot of pressure on companies, and what we're seeing is this inventory cycle and them trying to build up this inventory cycle, especially going into the holiday season. So companies themselves are acutely aware of how they're managing product, how they're getting it to consumer, and again, it's affecting inflation, it's affecting prices, it's affecting what their revenues are going to look like for the months ahead.
Yeah, very interesting.
So I talked a bit about some of these things, and job gains as an example. I've said earlier we think there's a bit of slack in the job market, and certainly that's the case, especially in the U.S. market. As an example, right now there's about 11 million jobs, Scott, that are open. 11 million positions in the U.S. market where companies are actively looking for people, and we know there's at least 9 million people out of work, looking for work, and we just can't make this connection yet. So we think there's some slack in the job market that we'd like to see get a little bit better. And we also think that's what the Federal Reserve is focused on. So yeah, high inflation, but they'd also like to see the job market get a little bit better, unemployment come down, participation rates come up. So participation rate is the amount of eligible people that can work, that are actively looking for work. And as soon as somebody stops looking for work, they're removed from the calculation. So we often see the participation rate bounce upward before we see unemployment. And that's a good sign. It means more people are coming back, more people are looking to the job market. And as these government programs expire or are pulled or scaled back, we think that'll continue to get a little bit better. Manufacturing, that's plateaued. You can see it continues to be in positive territory. It continues to expand, but come down from the highs. Part of that is pressures on the supply chain. Part of that is an increase in inventories. But part of that is cost, and there being less demand today for the same amount of goods that there was previous. And when I say previous, months behind us, quarter behind us, think about earlier this year. And that brings economic data, or at least the surprises to the positive side, they've also continued to decrease over time. So as I mentioned, we're expecting less positive surprises going forward, a more normalized environment, but we certainly have some stuff to work out in terms of inventory, supply chains, things of that nature. If we were to look at, the next slide, you'll see that pressure on the supply chain and what that employment numbers look like. Delivery times have continued to face a lot of pressure, slower delivery times. I'm sure if you may have read in the paper, you may have seen on the news, the amount of cargo ships that are sitting off the coast of Los Angeles waiting to get into the bay, and the U.S. government is trying to increase that process as well, getting goods to stores, getting goods to distribution centers, getting them to market before the holiday season. So there's a lot of work being done currently to make sure that people can really take advantage of the holiday season and earn all the revenue they can. And I mentioned employment. You'll see those 11 million jobs, the job openings with the employment rate. So the employment rate is certainly going in the right direction. We think there's a little bit more steam or slack it can make up, and we certainly expect that in the months ahead. So, inflation certainly has been top of mind. I'm sure you may have gone to the grocery store, Scott, or tried to buy even, an appliance or a larger ticket item. And I'm sure what most people have noticed is, regardless of what you're trying to buy, you either can't get it, can't get what you want, or it's significantly higher in terms of cost. And right now we're seeing inflation in Canada, the official number coming in just above the 4%, 4.1. I think if you and I were to sit down and think about that basket, we'd probably agree it's a little bit higher than the 4%. And that's more than double the longer term average in Canada at about 1.8%. But what we do expect going forward, well, we certainly don't expect inflation to average 4% going forward per year. We do think it'll come down gradually. By the end of 2022, we do think that inflation will be closer to the 2.2% marker. But again, that's going to kind of be an average. Q1 might be a little bit, lower than the 4.1. Q2 in 22 closer to 3, and over time it'll average closer to that long-term trend that the Bank of Canada wants. Now, if you look at what economists think will happen, they think it's going to be closer to 2.5%. Consumers think it's going to be closer to 3% going forward, and we think over time it'll moderate. So we think inflation is temporary, but when I say temporary, more of a longer drawn out process. Again, as we see some pressures on the supply chain being relieved, as we see some pressures on raw materials be relieved, and we can look around and say our experience in Canada has actually been pretty good with vaccination rates and the pandemic, but a lot of these materials, a lot of these goods come from parts of the world, parts of Asia as an example, where they've been in lockdown. Vietnam as an example has been in lockdown for a great period of time, and factories have only just started to open up, and again, put a lot of pressures on what we see here in North America. But we certainly see inflation higher. Like I said, gives more ammunition to the Bank of Canada, Federal Reserve to increase the rates a little bit earlier, maybe a little bit quicker, but we don't think they're going to do it in one fell swoop. It'll be slow, it'll be gradual. They don't want to scare anybody into a recessionary period. And you see that, with PMI, so Purchasing Manager Index, globally. This is where we survey boots on the ground. Where are the factories and who's ordering, the raw materials to make the widgets in that factory. Anything above 50 normally signifies expansion. Anything below signifies contraction. So you'll see it's rolling over a little bit, but remains positive and remains at a historically high positive as well. So again, good things. And again, why we think things will continue to grow, but just not grow as robustly as they have in the past. GDP growth, I've talked about that as well. 2022, the estimate coming in close to 5%, might be a little bit less than that as we go to a more normal environment, and we'll see a lot of that data come out of Q4, and we'll make those adjustments going into Q1 as well for 2022 and years beyond. Talked about central banks and tapering of those bond purchases. The Bank of Canada has already begun doing so. The Federal Reserve recently came out and said they're going to begin that process. And as you can see, currently, the amount of assets they purchase, which has really ramped up, and that'll slow, and it'll slow faster than they anticipate, again, because the recovery period has been so robust. Now, the tapering of the bond purchasing will certainly happen at a faster pace than increasing rates. So they'll put less cash into markets before they start to increase rates. And you can see the expectations over a longer term into 2022, into 2023, as they move closer to that 1% marker. So again, as I say, rising rates, but not quick, not necessarily high rates, still quite accommodative, because again, they want to stem inflation a little bit, and we do think markets and the economy can support some higher rates from here.
So what you're saying with this particular chart, the interest rates, the long term at 2.5%. I mean, so is it the which one, which is it the I'm trying to get a sense here. When the U.S. tapered their purchases, now the renewing bonds or that are coming up, the government needs to then offer a bond not to the Feds but to the institutional market. So in order to attract that market, they're going to have to increase rates. Is that what's driving the rates?
That's exactly right, Scott. And if you think about what a company is willing to pay, and if you think about slowing growth, what you find is we saw investors willing to pay less for a company's worth of earnings because, hey, I can also loan my money to a Canadian corporation that doesn't have a lot of debt that's now going to pay me a yield, and I don't have to take on a lot of interest rate sensitivity. I have a high degree of confidence in that type of company to pay me that yield of 4% or more, and I'm taking less volatility off the equity side of the market. Again, one of the reasons why we've built up high yield bonds in that type of portfolio. So if you think about, government debt, that's why I say the compensation is obviously not as great, loaning money to the Bank of Canada, loaning money to provinces, until rates get a little bit higher, especially with inflation driving at 4% or above. So this is just the ability of central banks to take cash, liquid cash, out of the capital market, as an example, pulling a little bit of liquidity out because they think it doesn't need as much liquidity going forward, doesn't need to propel the sustainability of the economy going forward, and pulling cash out of there. But the tapering of the bond purchasing programs will certainly happen at a faster pace than increasing interest rates. So as they want to move towards their target long-term of 2.5%, that's not a number we think they're going to get to anytime soon. And you can see going out to well beyond 2023 before we're even above the 1% marker.
Yeah, no, I get that. I'm just thinking of all the debt that the governments are taking on right now in order to, I
Yeah.
mean, they've got these interest rates, if I'm not mistaken, this is the interest rate the government is paying on that debt. And if you've got that much, I mean, we've never seen debt like this before. And you've got that much debt outstanding, and suddenly your rate goes from a quarter point to 0.75. It's only up 0.5%, but that's a big number it's a small number on a big number. That means that they've
Yeah,
got to
absolutely.
service that. Where are they going to pay for
Yeah,
that?
absolutely. Well, absolutely, right. And how do governments pay for it? We know very well that they don't have a lot of tools in their toolbox in terms of how to pay for that debt. And listen, tax increases are on the table,
Yeah,
but
right.
based on the amount of stimulus that they've put into the market, tax increases are just not going to be enough. So we have to see global growth continue to be positive. They have to continue to be accommodative to growth, which is why they're shifting from simply throwing cash to the market to spending more on infrastructure, stimulating the economy, stimulating jobs, spending on roads and bridges and schools and hospitals, all the things that promote better growth that's more sustainable going forward. Because, yeah, they don't have a lot of options in terms of how they cover and service this debt or shrink it over a period of time. And this is going to be something we're talking about for generations to come.
Yeah, no, you're absolutely right. Very interesting.
Yeah. So I talked about, I'll spend a minute or two talking about, valuations in terms of equities. We'll talk about bonds very briefly as well. But, I've talked about the price somebody's willing to pay for a dollar's worth of earnings. And you can see it's highest in the US market. That 20.7 X number means somebody's willing to pay 20.7 times for a dollar's worth of earnings. So if a company is earning $1, you're willing to pay $21 for the stock price based on that $1 of earnings. And this is what we see contracting. If we were to talk about valuations in terms of being fairly valued or expensive, we would say the U.S. market is most fairly valued of Canada and the international market as well. As we've shifted the portfolio, we've taken profits in U.S. companies and shifted to where we see better opportunities in the international developed market, increasing exposure to emerging markets as well. So again, we've made small shifts in the portfolio based on where we see opportunities of price increases going forward. Now, the other side of that is earnings. And if you were to go to the next slide, what you'll see is what we expect earnings growth to be. And you can see the longer term average of about 15% across the world. And we do think that'll continue to grow. So we do expect earnings to continue to grow. Canada being and proving to be most resilient. And we think earnings, when this year is in the books, will have grown by about 17%. And not a bad number, but comparative to U.S. international markets at the 15%. So world growing on average, Canada in terms of earnings growth a little above average. Obviously not sustainable longer term, but we think will continue to be positive, continue to be strong into 2022, which brings us to portfolio positioning. So although I've said we expect volatility to increase and we expect global growth to be less positive going forward, but continue to be sound, you'll see a bit of our playbook here. And of course, it's not as smooth as this line would point to, but you'll see in different points of the cycle where we want to be exposed, how we manage risk, the types of companies and sectors we want to be exposed to. And I would say we continue to be in this expansion and acceleration. So we're seeing high inflation. This would be the third quadrant closer to the middle of the screen, where risks are rising. We're seeing inflation. We're potentially seeing rates increasing very soon, and we're seeing markets more volatile. So as you mentioned earlier, Scott, continues to be very focused on the types of companies you own and your ability to put a lot of due diligence in and manage risks appropriately to make sure you can get that risk-adjusted return and squeeze a little bit more juice out of that lemon.
Yeah.
If we continue to look at how we've reshifted or rebalanced or shifted the portfolio, this is that same equity performance that I showed earlier, except what I'm showing here is all the changes and all the moves we've made. And I'll focus on 2021 and specifically Q3. Again, we've continued to rebalance, take profits in large global companies, reinvest those. We did it once earlier this year where we increased our allocation to Canadian stocks, and the balance of that has been building up high yield bonds, whether you own balanced or a little bit more aggressive in a growth oriented portfolio. We've also become more defensive in Q3, as I mentioned earlier, focused on the sectors, owning more staple, consumer staple type companies, owning companies that have the ability to defer those increased costs onto their end consumer. So we've certainly been quite active over this period of time. So if you were to look on the next slide at how the portfolio has been positioned, you'll see a bit of a guide here. So equities on the top, and you'll see our min, neutral, max positions, and then where we lie with Canadian stocks, large and small, global stocks, large and small. The biggest shift has been global large companies. So the darker little lug nut there represents the last quarter or the last update, and the lighter green lug nut represents where we want to be exposed today. So we see the green lug nut with global large caps moving to the left or moving more neutral, meaning we're decreasing our position. And that's being offset, if you were to look at the bottom of that screen, with high yield bonds. So that lighter green lug nut moving to the right or increasing our position. So we still want to be overweight equities versus bonds. We still think stocks will outperform bonds. But again, looking to risk-adjusted returns going forward, looking to manage volatility going forward, looking to make prudent shifts and take profits and reinvest those in opportunities that we see across the globe and across the spectrum of assets. But we continue to see those opportunities outweigh some of those risks, which is why we have that overweight to U.S. stocks. So it's hard to read, but monetary fiscal policy, earnings growth will continue to be positive. Consumers will continue to spend, but again, there's always growth and risks on our mind. Inflation, COVID, obviously, as we continue to live through a pandemic, valuations, the dollar of earnings people are willing to pay for, things of that nature. So as long as we think opportunity continues to outweigh risk, you'll continue to see us have an overweight in stocks. Unless we see some sort of a significant event, I don't think you'll see us increase our exposure to stocks in the short term. I wanted to spend a moment on bonds because I think this is something that certainly catches my eye, but certainly something that, well, based on performance, something some people may have noticed. And the middle of the screen, you'll see this larger yield curve, or what the Bank of Canada would pay you for loaning them money for 10 years. This goes back to January of 2020, and you can see how volatile it's been, but you can see it's obviously tracking up. Anytime that green line tracks up, means there's pressure on bond prices, which means negative rates of return. Now, if you look at the smaller little graph, historical Canada 10-year bond, you'll see what the pattern has been going back to 1979. And it's been a pattern of decreasing rates over that period. And our expectation going forward, we believe, will continue this pattern. Although we'll see Bank of Canada increase short-term rates, we don't expect a lot of growth out of the bond portion of the portfolio. We think there'll continue to be some price pressure there as well. So we own bonds, and as if we were to focus on a balanced type of mandate, we own bonds not because they're going to provide significant growth. We own them because they'll provide a bit of an insurance against volatility on the equity side of the ledger. And if we didn't have the ability to add things like multi-strategy or some of the other alternatives, real estate, infrastructure, private loans, clients would really have to ask themselves, as we talked earlier, about increasing their exposure to stocks to earn the similar rates of return going forward. So maybe, Scott, I'll leave it there. Happy to talk about anything else you think is top of mind or any questions that you may have. But simply put, portfolios have done quite well. We've become a little more defensive in our posture. The types of companies we own, taken profits in global stocks, reinvested in high yield bonds. but we continue to have an overweight as we believe stocks will continue to outperform bonds, and we're getting paid for that type of volatility over the short to medium term. So I'll leave it there, but anything you want to dive into a little bit more, just let me know.
Yeah, I mean, I don't want to take too much time on this because we've done I think, really a great job at keeping it so much plain English and sort of going through sort of all the main data points that you're paying attention to. But I think the one that's on the screen right now is so important to understand because up until this point, if we go back, like this goes back to 1979, right? When you can see in the 80s there when rates sort of peaked out. Back then you could just, you buy a bond, it's paying what 17%. It was pretty easy. Now inflation at that point was also running pretty high, so the delta between the two has to be taken into consideration. But as you did that, if you just held on to that and rates just kept on falling on the fixed income side of a portfolio, it was pretty easy to make a return.
Mm-hmm.
And so that
Yep.
was adding so much fuel to the portfolio, that was adding so much, contributing so much return, that you didn't have to rely on the stock so much in order to maintain that same level of return that we've been accustomed to over the past few decades. The If you don't have alternatives to turn to, and this is the point I'm trying to make, if you don't have alternatives to turn to, you can only rely on the other side of the portfolio, which is stocks. The only purpose for stocks really is to grow a portfolio. The problem is that we're doing so at the end of a market cycle, or nearing the end of a market cycle. So it just, I don't know, the writing's on the wall to me that there's so much risk right now that's building up that if you don't have alternatives to turn to and incorporate that into a portfolio, you're just going to have to be you're going to have to put a 5 point harness on to sort of weather that ride, because it's going to be a pretty rough ride.
Yeah, it's such a good point, Scott. And the only thing I could add to that would be through an example. I would much rather today, invest in an infrastructure project that has a 20 or 30-year contract with a Canadian province and finance the construction of a highway or a hospital instead of loaning money to the Bank of Canada for a 20 or 30-year period. Because I know that ride is going to be pretty bumpy. And when I get to the end of that ride, I'm not going to have much to show for it. So again, in terms of that risk adjusted rate of return, these alternatives provide, they fill in those blank spaces pretty nicely. And again, it doesn't mean we have to increase risk or increase volatility. It just means we're adding things to the portfolio that behave differently to the same types of information. So completely agree with you there. And yeah, certainly happy to have that available to us and to clients as well.
Yeah, great. Well, listen, thanks so much. I really appreciate you taking the time to go through all that and to explain it the way you did, because it is nice to have somewhat of a plain English explanation of it to just hopefully people will be able to sort of appreciate what is happening in the markets right now, what has happened, what the future holds, and they can understand that how the positioning of your portfolio right now, what you're doing to the portfolio is positioning to sort of mitigate against the headwinds that we're seeing, and capitalize on some areas that can still contribute to the portfolio. So I really appreciate you taking the time, and look forward as always to the next time we get together. And we'll let you get back to your day.